Hey guys, in this video, we're going to talk about implied volatility expansions and contractions. Now, this is a phrase that we use a lot of time at the end of our analysis videos when we're going over the different implied volatilities and expected moves for each of the underlyings. Now, we did make previous videos in the past about IV rank, and implied volatility, etc. So I would suggest to go back and look at those before you actually get into implied volatility expansions and contractions. And you can find those on our channel as well. Just go to the playlist and then go to education. Now, exactly what is an implied volatility expansion? Well, it's an uptick in volatility, and we can use that. We can use different metrics to look at the volatility. So we have the Vega, which measures the implied volatility compared to a price move in the stock. All right, and how it affects our contracts. We have the Vega. We have IV rank that we can use that kind of measures just relative the IV relative to itself over the past year. We have percentile, which is another weighted over the past year implied volatility metric. And there's different metrics that you can use to measure implied volatility or the expected move. You also have the raw IV here, and just kind of tells you 30% raw IV just in general. But how do we know if that's a lot or not? You don't really know. So you kind of have to use historical volatility to kind of go by that to see if that is going to be if that's a large number or if that's a small number. But what does it mean for implied volatility expansions? Well, when we're talking about that and we're talking about our options contract prices, an expansion usually means that there's going to be an increase in our options contract. So when we say we were looking for a pullback here, we're playing puts, we're looking for a pullback, and we're looking for implied volatility expansion. Well, usually when the market starts to pull back and an underlying pulls back and pulls back very sharply, there's more implied volatility, which means that the stock becomes more volatile. It is more subject to sharper swings and moves up and down. Therefore, the prices get really high because when you have a sharp move down, well, everybody starts loading up on the other side, right? Because, okay, well, you can't trade that high. So it does that. And then you just kind of repeat the process back and forth. So that's kind of what it means to be more volatile. And implied volatility is always going to be connected to an expected move in a stock. Because if all of a sudden it becomes more volatile, you have more buyers coming in. So you have a lot more volume coming in. Your Vega starts to rise. Therefore, your contract starts to get more and more expensive. Everybody starts buying these 680 calls here on Netflix for instead of 12. Now they're putting in at 1230, 1240. I just got to have it right now. I'm hitting the ask. I'm slapping that ask. And all of a sudden, your expected move starts to climb because these underlying options traders are going further and further out and saying, okay, well, everybody's buying the 680s. Well, I'm just going to go up here. It's cheaper to buy the 700. So I'm going to load up here. You can see there's 9,000 volume here. So volume starts kicking in here, etc. So that's kind of what we're looking for when we say expansion, is that we're looking for a price move in our options contract. And also when we talk about skew, call skew, put skew, we are mentioning that implied volatility expansion and contraction as well. So right here, just a quick overview on skew. Say we're trading at what, 685 right now. We go out $5, or we'll go to $10. The 695s are trading for $5.90 right here. If you go out $10, the 675 are trading for $6.90. So a little bit of a normative skew here, because $10 away, the 675s are trading for $6.90. And if you go $10 out to the 695s, everything's trading at $5.90. So your skew here is to the put side. So there's a little bit more of a volatility expansion happening to the puts here rather than the calls, because that is where all your risk is right now. So everybody in general always wants the stock to go up. So this would be a normative skew. Everybody wants the stock to go up. Your skew would always be usually to the downside, because that's where most of your risk is. If we do end up pulling back, then everybody will start loading up more and more on the puts. We do a sharp pullback, everybody will start loading up more and more on the calls. Then your expansion will start to happen over on this side. So right now, it looks like everybody is loading up on puts, and that's kind of where all your expansion is. And also, we have most of the people are buying puts and they're selling calls or writing calls to hedge their longs in here. You really don't sell puts and then buy calls while you have the stock, because you're not really, you can't really hedge yourself that way. So if you can hedge by writing calls and buying puts, that also gets that skew a little bit to the put side as well. So really an expansion in here to the upside, we would have to have a sharp pullback really in Netflix or some sort of news event coming up where you had a lot of underlying options traders start to kind of kick up the volume here. They start they're more buying the ask. You have big call buyers coming in here, and they're buying it above the ask, and they are just kind of predicting that, hey, there's going to be a move coming in here soon, and then your prices start to kind of expand in here on your options contract, and that's going to be considered your volatility expansion. And along with that, when that does happen, your implied volatility does go up, your expected move goes up, and then also your IV rank will go up too, and it'll compare itself to itself over the past year. And you can see if that is going to be where we're currently trading at with the IV, if that's high compared to a low IV. So is it high compared to itself for the last year, or is it actually relatively low compared to itself for the next year? So the historical data gives you a good idea, basis of where we're currently at. So when we're looking for an IV contraction, it's actually going to be after a big news event. So usually you have expansion going into it's more just speculation on speculation, right? So you're going into a news event, you're going to an earnings report. Say Netflix just happens to report earnings on November 19th, just for a hypothetical example here. Okay, so everybody's saying, okay, I guess the guidance, I'm thinking the guidance is going to be good, their forecast is going to be good. So everybody starts predicting, hey, guess what? I think this is going to start going up. So everybody starts loading up on the calls here. All of a sudden, everybody starts to kind of slowly buy into the stock. They start selling more puts, just to kind of, you know, I mean, if it does drop, they'll get in at a better price. And then before you know it, your skew here is going to be to the call side, and your IV is slowly expanding because now you have a lot of people predicting a big move in Netflix, right? But then immediately after that earnings report, say it's neutral or you know what I mean, even if it's bad, you have a little pullback. But it won't really pull back that much, right? So your expected moves is 18 in here, and let's just say it moves only $5. Well, all the volatility will get sucked out of these option prices. Well, because the news already happened. So we know exactly what Netflix is now worth, the price of the stock. We know the health, we know everything, because we just got all that information from our earnings report. So therefore, we're going to trade. It's going to trade what it's worth, what it's valued at. So therefore, there's no more speculation in here. So that's when all the implied volatility contracts out of that, because what we were speculating on already happened. So now it's no longer speculation. It is just fact, and it's just data. So therefore, that speculation that we had underneath the more speculation is now contracting, because we actually know where it should be at. We know that these calls shouldn't be trading this high anymore, because we know the stock is not worth 685 anymore. It should actually be trading down here to 670. So therefore, all these calls, the implied volatility will get sucked out of them, because you know what, the volume is going to go down, the Vega is going to go down, and in turn the price is going to go down, because nobody is really going to want to try to trade it up here anymore, because we know it should be trading down here right around 670, 665. So that is more or less what a contraction means. So a basis of it is all look at your option price. So look at your option price. If you click on just on your Robinhood, your Webull, whatever, you click on an actual option contract itself, and you can actually see the implied volatility for that actual option. So Tasty Trade doesn't really give you that. You click on it, it doesn't really tell you anything about the implied volatility in here. You kind of have to go by the option expiration date and then make your judgment from there. But you can just click on in Robinhood the 670 calls, and you can see how much implied volatility is actually in there. So that you can actually see that there's implied in volatility wrapped in all of these expiration contracts, and that's also the Vega in there as well. It's not the Vega, but it is related to your Vega in your options contract. So yeah, that's kind of what it is. I know it's kind of confusing because the skew, the Vega, the implied volatility, expected move, the volume, the bid and the ask, they all wrap around kind of the same thing, right? And the bottom line is it is speculation. So speculation comes in, and the more speculation you get, the higher prices you get, the higher expected move you get, the higher the implied volatility becomes, your IV rank becomes bigger, and then that's when you get your expansion. If you get the reverse of all of that, then your contraction comes, and that's usually because there's no longer speculation, because either the people just are not interested anymore, or the stock is trading above where it should be, or it's trading exactly where it should be. So yeah, I get it that it's kind of confusing, but again, you're just kind of looking, just watch your price, click your options contract, see if, even though the underlying is not moving a whole lot, if your options contract is going up in value, then that means that the implied volatility is expanding in there. And then the opposite for the contraction. All right, guys, thanks for watching. Make sure to check us out on our social media. If you have any questions, again, feel free to reach out to us. We do have attached links to our socials in the description, and we also have a trading service if you're interested. There's more information in the description below.